Hi guys, and welcome to class. Today we are going to be going over individual taxation. The way that this is going to work is individual taxation is actually going to be split into two lectures. We're going to start with regulations 1, and that's going to be our income. And then we're going to go into regulations 2, and that's going to be our itemized deductions, our adjustments, our taxation, and then our other taxes, and a couple of miscellaneous issues. Today we're going to start with sort of the big picture of individual tax. So if you guys can go to page 3 of your Regulations 1 lecture, and we'll take a look at what it actually entails. And what it is it's sort of your general equation on page 3. And your general equation has gross income minus adjustments, which gives you your AGI, your adjusted gross income. And your adjustments are also known as deductions to arrive at AGI, which makes sense. Those are your above the line or above AGI deductions. Then you're going to either take the standard deduction or itemized deductions. Itemized deductions are slightly less special than your adjustments, but they're also pretty good. You get to group those together and see if they're larger than the standard deduction. And then you either take the standard deduction or the itemized deductions from your adjusted gross income. Then you get your exemptions. We will actually look at those today. We will look at those right after the filing status. So we'll look at those next. And then you arrive at your taxable income. From your taxable income, you calculate your federal income tax, you take some tax credits, and then you have some other taxes, and you subtract your payments, right? And you arrive at tax due or a refund. It's funny because on certain states' tax returns, states actually put a smiley face next to a refund and a sad face next to a payment. I'm pretty sure Arkansas does that. If you guys could go to the next page, so we're moving on to page 4, and you'll see that on page 4 we just have a breakdown. We just have sort of an unwrapped or unraveled equation that we saw on the previous page. And so you'll see that you have all of your income items listed. And we'll actually take a look at all of those in today's lecture. We're going to take a look at our wages, our interest income, our dividends, our capital gains, retirement income, and so on and so forth. Then you have all of your adjustments. And we're going to take a look at those in R2. And then you have all of your itemized deductions. We're going to take a look at those in the second lecture as well. And then you have your exemptions. And exemptions, as I said, is one of the first topics we will look at. They generally don't ask you for the amount because the amount of an exemption per person is actually adjusted on an annual basis for inflation. And AICPA is too lazy, should we say, to rewrite the questions. So what they will ask you for is they will actually ask you for a number of exemptions that you're getting and not the amount of the exemption in dollars. So, we know that it's about $3,800 for 2012. However, I doubt that they're going to have you calculate that without maybe even giving that number to you first. So it's going to be much more about understanding the material and understanding the theory behind how you get the extra exemptions, and we'll see that those have to do with dependents, that it will be about having, $21,000 or $25,000 that is associated with that specific topic. All right? On page 5, you'll see that we actually have our form. That's our 1040, right? And you do want to know the form numbers, all the major ones, and I'll point them out to you. So the 1040 you definitely want to know. And you'll see that on page 1, lines 7 through 22 are your income items. That's predominantly where we're going to be concentrated today. And for those of you that are taking the course for the first time, you will see that the outline in the book, the Becker outline, actually follows the form pretty closely. So we'll take a look at wages, then we'll take a look at taxable interest, we'll take a look at tax-exempt interest. All of that is going to kind of follow almost in a line in this really nice outline form. And so whenever you look at the form, whenever you get a simulation filling out one of the forms, you would have had the theory aligned in the way that you've studied, should we say, is going to be aligned with the way that the form itself works. And the reason that we do that is so that you can have that correlation between the form and the theory, because that's where a lot of taxation comes together, right? You'll see that you have your page 2, and we'll take a look at the details of page 2 a little bit more in regulations 2. All right, looks like we are about to jump into the meat of the material, and that's kind of what do I do and what do I when do I file, what do I file, who am I, what dependents do I have, am I single, am I married filing separately, what's my status, sort of the basics. You'll see that on page 7 of the book, we talk about filing deadlines and payment deadlines. So we all know, or most of us know, that we can actually extend filing our tax return until October 15th, as long as we file an extension, Form 4868, by the April 15th deadline. However, we cannot extend our payment or the time to pay. The IRS will want you to still pay any taxes if they're due by the April 15th deadline. You can file your forms as of October 15th or by October 15th, but you have to have all of your taxes for the prior year paid in by April 15th deadline, right? The IRS wants their money as soon as they can have their money. And there are payment penalties or late payment penalties that are associated with not making that payment by April 15th. So an example that you might see on that, even though this is not a tremendously testable point, an example that you might see on that is them saying, your tax return is due April 15th of year, 2013, and you filed an extension, and so you're allowed to file. They'll just tell you filed an extension by October 15th. However, they'll say it took you a little bit of time to gather your information, and so you made your payment by May 31st. And the multiple choice question is going to ask you what kind of penalties, if any, do you have to calculate for this client if there is a penalty associated with the way that things have been done. And there's not a late filing penalty because you filed your extension by 4/15 to actually file the tax return by October 15th. However, there is a late payment penalty because just filing the extension does not alleviate you from having to pay all of your taxes by the 15th, by April 15th, right? So I hope that makes sense to everyone. Okay, good. So let's move on to page 8. And we are in the filing status land. So this is your first looking at forms kind of topic, and we're going to be doing that a lot during this course. So filing status, you'll see that on top of the page, you actually have a part of the form that shows you all of the potential filing statusi that you might have. And your traditional one, if you're not anything else, then by default you're single, right? And if you're not anything else, meaning if you're not married filing jointly, married filing separately, head of household, or widower status. So the biggest testable point or testing point on the single filing status is the fact that you determine your status as of the end of the year. So if you got married on December 31st, you're going to file married filing jointly, for that year. However, if you, for example, got separated on December 31st, or you got divorced on December 31st, that you're going to be filing with a single status for that entire year. So that's the only testable point, and that's probably going to come through as a part of a simulation of you having to determine what status to give to a taxpayer. Then you have your joint tax returns. And for your joint tax returns, you can be married filing jointly. The biggest point there is in subsection 3, and it says that if one of the spouses dies during the year, the other spouse will still get to file married filing jointly. And that's, huge, or not huge, but that's kind of government's way of saying, we're so sorry your significant other died, you still get to file married filing jointly. Then the next status is our qualifying widower status. That status actually follows the year of death for 2 more years. So in the year of death, you get to file married filing jointly. And then assuming you meet the qualifying widower requirements, you're going to get to file a qualifying widower status for the following 2 years. So we've now looked at the 3 years, right? 1 during death, or 1 the year of death, and 2 more years following the year of death. The good thing about, or why we care about filing either married filing joint or qualifying widower or even head of household is because it's a wider tax bracket, meaning more of your money is going to be taxed at the lower rates, thus producing a smaller tax liability on the same amount of income. Okay. So for qualifying widower, you have to have a child, a dependent child, that is living with you. That is kind of the bottom line of that, is your husband just died or your wife just died and you guys had a dependent, a qualifying child, the definition of which is pretty well defined, who is living with you for the whole year. Okay? So if the child is living with you for the whole year, then you're all right to apply for the qualifying widower status for the 2 years following your husband's or wife's passing. Then you have your head of household status, and your head of household status comes in on the 4th year, right? So you go married filing jointly, qualifying widower, qualifying widower, and then head of household. And you also look at the requirements for the head of household, and that status does not have a limitation. So whereas the married filing jointly is only allowed for 1 year, qualifying widower is allowed for 2 years, head of household status is allowed for as many years as you need, as long as you qualify within the requirements put forth by the Internal Revenue Code that tell you when you are a head of household. And those requirements are: you're not married, you're not a qualifying widower. If you are, you're going to take that status because that's an even wider tax bracket. You are a U.S. citizen. Okay, pretty reasonable. And then you have a dependent that is living with you for half a year. They really love testing that point. It's this point of widower whole year, dependent living with you for the whole year, head of household, dependent living with you for more than half of the year, right? Your father and mother qualify as a dependent. They can live outside of your home. They can live in a retirement community as long as you provide more than half of the support. Your children have to live with you for half of the year in your home. And then essentially nobody else who is not a relative qualifies. So you'll see there is a nifty little table on the bottom of the page that summarizes how this works. Children, they have to live with you. They have to be dependent. Parents, they have to be a dependent. They don't have to live with you, but you have to provide more than half of their support. Non-relatives do not change your status at all. And your relatives, any other relatives, as defined by the code, have to live with you for the whole year and have to be your dependents. So the story that I usually like to leave this with is, I am a pretty self-sufficient girl, and I was really lonely, and so I started dating somebody who is, oh goodness, I don't know, what are we going to make him? We're going to make him a circus somebody, a performer, there you go, a circus performer, and he's not making very much money, and he's living with me, and he's driving my car, and he's living in my place, and I'm buying food for him, and all that. And then in the end of the year, when I start preparing my taxes, even my tax return reminds me that even though he's been living with me for the whole year, I very much am still single. Thank you guys. Let's take a little break. We are going to go into exemptions after this and then move on to income.